Hello, welcome back to my channel. This is Ben Morales, your financial consultant here. And I want to address an issue here, why you shouldn't borrow strictly based off of interest rate. So when it comes to borrowing, when you're a consumer, how you borrow money is more important than how much you're being charged for borrowing. So when I worked at the bank, I had a customer, they would come in, they're looking for, in this case, a vehicle loan. Part of my job was to find out how long they want to be in that loan, and then I present the interest rate that they were going to get for that particular loan and how long they were going to be paying monthly payments. So again, how you borrow is more important than how much you're being charged to borrow. And we're going to see this real life scenario. We're going to show why that's a false way of thinking, or it's a dangerous way of thinking, because it can put you in a bind over a long period of time. So we're going to help this client to more quickly and efficiently pay off her vehicle loan. Instead of paying it off in 2.5 months, we're going to show exactly how she's able to do this in just 15 months. So let's get a background on the client, including what her goals are. So this is the client's income, expenses, debt, and her cash flow. Okay. So at the end of the month, her cash flow is $441.75. This is what she has to work with after she's paid off all her expenses. And we're going to talk about exactly what are her expenses throughout the course of the month. But I want to highlight what her debt and what is comprising the $36,994.23 of debt. They are comprised of a car loan and 2 student loans and then a couple of credit cards. So not a lot of debt, but again, when you're someone, you only have $441.75 of cash flow, it can feel like forever before you're going to finish off getting out of debt. And this is very typical for a lot of consumers here in the United States. We get student loans, we get car loans, et cetera, and we end up in situations very similar to this one. So if we look on paper, these are her debts. What we're going to look at is the interest rates on those debts. Okay. We're also going to see what potentially we could do in terms of her savings to work with. She has a savings of $3,000, and these are her goals: to pay off her car loan in 2.5 years and to pay off her student loans in 4 years. So for someone who has student loans, it could be a daunting task, right? Because it feels like you're in those loans forever and they're never going to get paid off. So when we look at where she's at right now, we're going to look at what's called the cash flow index. And if you watch other ones of my videos, you know that the cash flow index, what that tells you is, as a borrower, is how efficient the loans that you have are. So the higher that number is to 100, the greater a portion of your debt payment or of your payment is going toward principal. So we can see here, this is why I said at the beginning of the video, don't just borrow based on an interest rate, because this car loan, which is her interest payment, her payment is $454. It has an interest of 1.9. Okay. So you look at that on paper, you're fantastic. I got a very, very low interest rate for my car. However, see this 32 right here? That's our cash flow index. That's how efficient the cash flow is in applying toward that principal when she makes a payment. So that cash flow index is very poor, 32. Okay, 32 is bad. Anything between 50 and 1, that's a very bad loan. Okay, you borrowed at a very bad rate. And the way you figure that out is you just take the balance that you owe and you divide it by your monthly payment, and that will give you your index, your cash flow index. Okay, so again, a bad loan because it's in between 1 and 50. If you have a loan and your cash flow index happens to be between 50 and 100, there's some room for improvement, right? Definitely, especially if you're on the closer to 50 than you are to 100, but there's definitely room for improvement. So as we calculate, we look at all the debt that she currently has, we can see that the best loans that she has is indeed those student loans, which have an 89 and an 86 and a 106 cash flow. So we're going to have to tackle these other debts right away so that we can improve her cash flow. And the way we're going to do that is we're going to take $3,000 that she has in her savings, and we're going to immediately eliminate 2 of these outstanding credit card debts, which is this one here and this one here. When we do that, we are going to get back into our cash flow $73. So we're going to add that to our cash flow, $73. What that is going to do is that it's going to improve our cash flow to $514.80. And so what we did is we added that to her cash flow. Her cash flow now becomes $514.75. That is going to be her net cash flow. Oh, and I have a typo here. Let me go ahead and fix that. That should be 514. $514.75 is the new cash flow. In addition to that, we're going to add $73 because she no longer has these two credit card payments. She's no longer paying the 27 and 29%, and her cash flow to invest is also being eliminated. Okay, that cash flow is now becoming available to her. So now the next thing we do is we're going to look at other ways that we can improve her cash flow. Well, we know based upon her expenses, which is listed right here, okay, if we add all these monthly expenses, we're going to come to the realization that those monthly expenses accumulated to total $946.25. So what that does is that brings her cash flow, it improves it now to $1,461. What we do with that now we have a plan. We have a clear plan. We know that we're going to have at least $514.75 in cash flow. And then we're also going to be able to leverage $946.25. Why? Because she can run all these expenses to her credit card that has now been paid off. Now, what she's going to do is one of these credit cards, I believe it was the Discover card, it had the limit of 9,600. So she can then leverage that debit card for her monthly expenses, and that's what she's going to do. Every month, she's going to be running these expenses. And if you've seen other videos I did, that you know that when you use a credit card and you're leveraging that to run your expenses, you run your expenses, you're going to have a 21-day grace period, 21 to 24. When that period is over, it's going to generate a statement, and that statement is going to give you a due date. So you do have some time between making your purchases, between that purchase time and the time that you actually have to make the credit card payment. So that's what this is here. This is the layout. This is how it's going to look. So take a good look at this. If you find yourself in the same situation where you have a vehicle loan, but you also have some credit card debt, okay, you can take and leverage, eliminate. The first thing you want to do is eliminate that credit card debt. I showed you really quickly how you can do that, but here's basically what the impact of that is. So we're going to see that on the very first month, she's taking her balances, 14,601, and we're going to deduct that new cash flow, $1,461. Where did we get that from? From the two items that we added in her cash flow. We just improved her cash flow significantly. Okay, she was at 441, now she's at 1461. She's running her monthly expenses through that credit card. She knows she's going to have some time before she pays that. So we deduct the payment of month number one, and this is the new total. What you see here is I'm adding the interest rate for the car loan. Okay, it is 1.9%, so it's very, very little interest that she's paying. Okay, the next month she's only going to have $514.75 available, because what's happening in that month is she has to now pay off the $946.25 in credit card that she charged throughout the month. So in essence, when you borrow, again, everything is when you borrow, you're borrowing and you're leveraging your credit, and you're giving yourself some time. You're giving yourself as much as 30 days by running expenses through your credit and then paying it off. You're going to pay it off in full. If she stays true to her expenses, she'll be paying $946.25 off in full. Okay. Will she be charging the interest rate? It doesn't matter. This interest rate on her Discover card was 27%. That will not matter, because she is going to liquidate, totally pay off her credit card. It will zero it out, and then she'll rinse and repeat and start the process again. So we can see 1 month is 514.75. Add back the interest. The next month is the larger month. She's running her expenses through the credit card. That payment is 1461. You can see how it's deducting. $19 is her interest rate based off of that. So we can see just here in 3 months, 1, 2, 3 months, she's brought down a $14,000 car loan to $11,208.60. And then this strategy, right? This velocity banking strategy is not rocket science. There's a lot of people saying that it's a very difficult strategy. It really isn't. It's numbers, and numbers don't lie. It's about where you put your money first. Stop giving it to the banks. Stop giving it to the loans. Get yourself a line of credit. In many cases, a credit card can be used just as easily as this. In another video, like I said, we'll show how we can do this with a personal line of credit. See if we can get that time sped up to even quickly. But the gist of it is this: we continue to follow every single month. As she's paying down her credit card, there's what's happening is that balance is being really, really paid off a lot more quickly, to the extent of at the end of month number 14, she's at $939.10. Obviously, the last payment that she will make to her credit card is going to be for 900, or rather to the car loan is going to be $939.10. Now, when we look at the actual amount of interest that was paid, it's very, very little. We're talking about 23, 21. That's about $43, $44 worth of interest. 19. That brings it down to 44. Another 20 bucks we could say. 64, 78, 83, 90. Let's say round it up about 100 bucks. We're going to look like in total she's going to end up paying less than $200 worth of interest in a period of 15 months by implementing this strategy, right? And leveraging her credit card to run her expenses, while at the same time adding the additional cash flow to her vehicle payments. So now let's go back to what her goal was. Her goal was, we saw at the beginning, she wanted to pay off her car in 2.5 years, right? She was already a couple of years into this loan, but we can see again, even though it was 1.9, the interest rate that she had, this was a very bad cash flow index loan, because a very small portion of her principal was being applied, or the very small portion of the cash flow was being effective into the payment of the car. So again, you go to the bank, they're going to tell you, yeah, we can do this over 5 or 6 years. You have a very, very low payment. How you borrow is more important than the amount you're paying for when you do borrow. So keep that in mind. So this was a very poorly designed loan. It's much more better to use a line of credit. It's much more better to use a debt tool like a credit card. Run your expenses through it. Apply the extra cash flow to the payments, and you'll be out, like this example says, you'll be out of your loan in just under 15 months. So I hope this information helps you. This is the kind of things that we work with our clients. It's going to help her free up a lot of her time. It's going to help her free up her expenses and be able to do some other things that she'd like to do as well. So if you like the information, please comment, subscribe, share this video with others, with your friends. Maybe you know someone also that has a car loan, and this is a car loan that she got a couple of years back. So we know that the rates for cars over the last couple of years are a lot higher than this, but it really doesn't matter. It's how you borrow. We can get you into a personal line of credit. We can get you into using a debt tool that will help more quickly and efficiently pay off the debt. So please follow, share, subscribe, and until the next video, thank you so much for tuning in today.